Good morning. We're going to go over chapter 5. We're going to work on the homework problem, which is problem 5-3A. In this chapter, we are looking at merchandising businesses. This means that these companies have inventory. They buy inventory and they sell inventory, and that's how they make money. So they either call merchandising businesses or they call retailers. So let's take a look at our problem. So let me move the screen over. We are looking at journalizing, posting, and preparing a trial balance, and then finally preparing a partial income statement. So what do we have in this problem? At the beginning of the current season, on April 1st, the ledger of Granite Hills Pro Shop showed cash of 2,500, inventory of 3,500, common stock 6,000, and then the following transactions. So they've given us three accounts that have a beginning balance on April 1st. After we go through all of these transactions, they're telling us that the chart of accounts for Pro Shop includes cash, accounts receivable, inventory, accounts payable, common stock, sales revenue, sales return and allowance, and cost of goods sold. This is basically giving us a hint that these are the accounts we're going to use when we prepare all of these transactions. So we'll have to prepare T accounts for each of them. So in the instructions, we've been told to first journalize the April transactions using the Perpetual inventory system. Then they tell us using T accounts, enter the beginning balance of the ledgers and post the April transactions. And then finally, in part C, they tell us to prepare a trial balance. They've given us a total number as a check figure, and then the income statement. So let's go back to the top over here where we started. So again, let me minimize the screen there. So we have cash with a beginning balance of 2,500. So I have these accounts already set up, and that's based on the information that was given to me earlier. I've set up a shell for my journal entries, the general ledger, the T accounts, trial balance, and income statement. So let me first start with the T accounts. For cash, I have 2,500. That's a debit balance, obviously, because it's an asset. Then I have inventory 3,500. So inventory on the debit side, I'm going to put 3,500. And common stock 6,000 on the credit side. Unless mentioned otherwise, we always assume all accounts have normal balance. So now that I have that in place, I start with my journal entries, my transactions. On April 5th, we purchased golf ball bags, clubs, and balls on account from Arnie Company. $1,500, terms 310, net 60. Let's analyze this information first before doing the journal entry. We have made a purchase on account, which means it's a credit transaction. I'm not paying the cash right now. The bill or the invoice is $1,500. That's how much I owe. The terms are 310, net 60. That means I will get a 3% discount if I pay within the next 10 days. Otherwise, I have to pay the full amount within 60 days. So the next 10 days, you start counting from the day after the transaction happened. The invoice is on April 5th, so you'll start counting from April 6th onwards. You have 10 full days to make the payment and get the 3% discount. Otherwise, you pay the full amount in 60 days. So we will start out by writing the date, which is April 5th. I made purchase of inventory. So as we're using the Perpetual inventory system, inventory is going to be debit. I'm not paying cash. It's a credit transaction. So accounts payable credit. The amount is $1,500. So I'm going to put the $1,500 on the debit and the credit side. Now, for this transaction, I am going to go ahead and write a small explanation. I'm writing terms 310, net 60. So that I remember when I make the payment, whether or not that discount should be taken into account. Now, the next step is I'm going to post this information into my T accounts. So inventory debit, on the debit side, I'll put the 1,500. Accounts payable, on the credit side, 1,500. This is called real-time posting. As soon as a transaction happens, I do the journal entry and I post into the T accounts. On the 7th, that's the next transaction. On the 7th, I paid freight on Arnie purchase. The purchase I made on the 5th, I've paid for the freight. I paid, which means cash is credit. That part is easy now in this transaction. I paid cash. Now, what should I debit? In the perpetual inventory system, all the cost associated with bringing the inventory in gets added to the cost of inventory. So the account I'm going to debit is inventory. Inventory debit, cash credit. Again, let's post it. Inventory debit, cash credit. Moving on to the third transaction. On the 9th, I received credit from Arnie for merchandise returned. So of that $1,500, $200 of merchandise I have returned. So on the 9th, I'm basically going to take this first journal entry and flip it. So my journal entry is going to be accounts payable, debit, inventory, credit. So I've reversed this journal entry for $200. Basically saying I didn't want the inventory for whatever the reason may have been. It's probably because the inventory was not to my specification, it was damaged, any number of things could have gone wrong. I have returned it and they've told me, okay, you don't have to pay the $200. I'm crediting inventory to reflect that I don't have the inventory with me. I'm debiting accounts payable to indicate I don't owe that much money now. So what I owe is $1,300. Again, let's go ahead and post it. Accounts payable debit, inventory credit for $200. The fourth transaction now is April 10th. We sold merchandise on account to members for $1,340. Terms are net 30. The merchandise sold had a cost of $820. Again, let's analyze this a little closely. I have made a sale on account. I didn't get cash. I'll get the cash later on. Am I offering any discount? No. I'm just saying you have 30 days to make the payment. And since we're using the perpetual inventory system, I'll have to update my inventory records with this amount. So let's first do the first part of the journal entry. So my first journal entry is going to be accounts receivable debit, sales credit, and that's for $1,340. The second journal entry I'm going to do is to show that I have now given up inventory. The inventory that I gave up is $820. I gave that up in order to make the sale. This now effectively is the cost of goods sold. So in order for me to make the sale, I had this inventory that I sold, which is $820. So the profit on this transaction is sales minus cost of goods sold. 1340 minus 820 is the profit on this particular transaction. But we're not going to do transaction by transaction. We do it at the end in the income statement. So let's put this information in our T accounts. Accounts receivable debit, 1340. Sales credit, 1340. Cost of goods sold debit, 820. And inventory credit, 820. Then we're told on the 12th, we made another purchase of golf shoes, sweaters, and other accessories, again on account from a different vendor. Wood Sportswear for $830. The terms are 110 net 30. Not as generous as that other one, the first purchase that we made, but nonetheless, we have some discount to look forward to. So here we have, the terms for the previous transaction, which was a sales transaction. I'm just writing there net 30. Okay. So the purchase transaction we know is fairly easy. It's just as we had before. Inventory debit and accounts payable credit. We also know the amount. The amount is 830. And we're going to write down the terms. The terms are 110 net 30. Again, to remind us when we make a payment, if we make within 10 days, we'll get that 1% discount. Now let's work on this. Posting to the T account, inventory debit, accounts payable credit, and that's the $830. Now on the 14th, I paid Arnie Company in full. So how much did I owe Arnie Company? So this was a transaction. I'm going to highlight this for a second over here. Now let's take this color. Oops, just a second. Shouldn't take me this long to figure out how to undo something I've done over here. Just going to highlight both of these to show you that it's the accounts payable that I'm concerned with. Accounts payable is 1,500, but if you recall over here, I returned $200 worth of merchandise, so it's only 1,300 that I owe. The next thing to take into account is a date. The date is April 5th, the date of the invoice. The terms were 310 net 30. So the question is, on this day, now we're looking at April 14th when we're making the payment. Is it within 10 days from the invoice date? And the answer is yes, which means I'll get a 3% discount on the amount that I owe. So first is, how much do I owe? Accounts payable is going to be debited 1,300. Of this, I'm going to pay not the full 1,300, but I'm going to pay 97% of that amount. 1,300 times 97% because I'm getting a 3% discount. And what happens to the other 3%? The $39 that I didn't pay, to the extent I got the discount, my inventory is that much less expensive, so I credit inventory. So again, in the perpetual inventory system, when I buy inventory, I debit inventory account. When I pay for freight to bring the inventory in, I debit inventory. If I return the inventory, I credit it. When I sell it, I credit it. When I get a discount, I credit it. So all adjustments are being made to the inventory account. Okay, now that I have this in place, let me put the, or just a second before I do that, let me explain the reason why I had to go through these two journal entries over here to see how much I owed the vendor. If I had just looked at the T account, 1,500 minus 200 is 1,300, but then I had another credit, another purchase was made. That was with a different vendor. And also it doesn't relate to this particular bill I'm paying. So always make sure you don't jump to the T account, but look to see how much you owe that particular vendor for that particular invoice before you take the discount. Okay, so now I'm ready to post the journal entry into the T accounts. Accounts payable debit, cash credit, and inventory credit. Okay. On the 17th, I received credit from Wood Sportswear for merchandise returned for $30. Okay, so I have received credit over here. So what are we looking at? Now this is another transaction. Okay. This is similar to the one where we had over here where we made a return. Accounts payable debit, inventory credit, the same thing over here. Accounts payable debit, inventory credit. I made a return of $30. Of this 830 that I purchased, I returned $30 worth of merchandise and I got credit for that. Okay, so accounts payable debit, $30. Inventory credit, $30. On the 20th, I made a sale on account for $810. Again, the terms are net 30, which means I don't offer a discount. They have to pay me within 30 days. The cost of the merchandise is $550. So it's going to be very similar to this. It is similar, exactly the same as this journal entry. We're going to have that down over here. So let me first. Okay. Accounts receivable debit, sales credit. So the sale was for $810. I debit accounts receivable, I credit sales for 110. The cost of the merchandise is 550. So cost of goods sold debit, inventory credit for 550. Let's go ahead and post this. Accounts receivable debit, 810. Sales credit, 810. Cost of goods sold debit, where's our cost of goods sold? Cost of goods sold debit and inventory credit. Okay. On the 21st, we paid Wood Sportswear in full. Now, how much did we owe them? If you recall, our initial purchase was for $830. We made a return of $30, so we owed them $800. We're paying that in full. The purchase was made on 12th. We are making the payment on the 21st. Question is this within the credit period? And the answer is yes. Okay. So our journal entry is going to be accounts payable debit. The amount we owe them is 800. We're going to pay them cash, but the amount of cash we're going to pay them is 792. How much discount did we get? We got a 1% discount. Different color here, 1% discount. So the inventory credit is going to be for $8, 1% of the amount that we owed, because the terms were 110 net 30. If you recall the first purchase, it was 310 net 60. So this was a less generous discount. Nonetheless, it was a discount. We're paying $8 less. So we saved $8 over here. So accounts payable is debited, $800. Cash is credited, $792. And inventory is credited, $8. Okay. On the 27th, we granted an allowance to members for clothing that did not fit properly, $80. Now, how is this different from returns that we have made? So a customer, we granted it to a member. So someone who made a purchase from us came back and was unhappy with the purchase they made. Now, it's not uncommon where a business will tell the individual, just keep the merchandise, we'll give you a small discount. And very often, customers will be very happy with that accommodation and they will keep the merchandise. So why would a business do this? Why would they let you keep the merchandise and give you a discount? It's for a couple different reasons. The first one is to build goodwill. They want your business again. The model for any business is they want repeat business. They don't want to get a customer so upset that they're never going to come back again. I want you to come back again. So I want you to keep the merchandise. I'll give you a discount. And also remember, when merchandise comes back, it's no longer new. And I can't sell it as a new item. My chances are I'll have to discount it anyways. And then I'm going to hope that it sells. So I'm probably better off by just letting them keep it and give them a small discount. Okay, so how do we handle the accounting aspect of it? So let's start out with I write my date. Okay, they owed me the money. They're not going to pay me that money. So accounts receivable is going to be credited for that amount that they're not going to pay me. Okay, I need to debit something over here. So effectively what you're looking at is this sale that happened, it's that much less. Okay, so I need to reduce that sale amount. But you know that we never debit the sales account until we are closing the books at the end of the period. So I need some other account in which I can hold this return. So that account is a sales return and allowance account. That's the one I'm going to debit. It's a contra revenue account, which means the only purpose of this account is to reduce the sales account. So sales minus sales return allowance will give you the net sales number. That's a real sales number. Okay, so we've created this contra account in order to adjust the sales number. So do I need to debit inventory? No, I don't, because it never came back to me. The customer did not return the inventory to me. They kept it. I just gave them a discount. So let's post it. Sales return allowance debit, and revenue is a credit account. So sales return allowance has to be a debit account. The purpose is to reduce the account. And accounts receivable credit, well, my accounts receivable over here. And that's going to get credited $80. Okay. Now, on the 27th, we just finished that. On the 30th, we received payments on account from members for $12.20. Okay. Now, there were two sales made. Here we had the accounts receivable over here, and we had accounts receivable over here. Do I need to keep a track of who I'm collecting the money from? Well, yes, in my special journal, I will have that information. to find out which customer has made the payment. However, for the purposes of the journal entry over here, it doesn't matter because I wasn't giving anyone any discount. That's the reason it doesn't matter. Okay. So my journal entry over here is fairly straightforward. Cash debit, accounts receivable credit. They pay me 12.20. So cash debit, accounts receivable credit. So I have to debit cash on the debit side here, and accounts receivable on the credit side, I'll have to put 12.20. So at this point, we've taken care of all the journal entries and we've posted everything into the T account. So once we're done with that, our next job is to close the T accounts so I can prepare my trial balance. Closing T accounts, if you have, again, you should be familiar with this by now, but just to kind of recap what we do, if you have multiple debits and credits, you add up both the sides. And once you add the sides up, take the difference between the two sides, the total debit and total credit, and the difference, put it in the side which is larger. So 37.20 minus 21.33, I'll put it on the debit side. Same thing for accounts receivable. I will add the two sides, take the difference, and for accounts receivable, it has a debit balance, as do all assets. That's another way to check your work. Inventory, again, I add up both sides and I will see on the debit side what I'm left with. Accounts payable, you add up both sides and you will see that you have nothing left over here. Okay, so you're left with a zero balance, and I'm putting it on the credit side because normal balance for accounts payable is zero. Okay, which means accounts payable is what I owe. At the end of the period, zero. I don't owe anyone anything. Coming down to common stock, I have a double underline under the 6,000. There was no entry, there were no transactions that affected common stock, so the opening balance is effectively the closing balance for me here. For same thing for sales return allowance, there was only one entry. Now for revenues and cost of goods sold, there were two entries, so we just add up the amounts to find out how much we have over there. Okay, so now that we're done with that process, we're ready to prepare our trial balance. In our trial balance, always first line is name of the business. Second line, you identify the statement. In this case, it's a trial balance. Third line, a trial balance is always as of a particular date. So in this case, it is April 30th, 2020. What do we have over here? We have accounts. We have the item. Each of these accounts, whether they have a debit or a credit balance, we bring that over. Also remember, any account that does not have a balance, we do not bring it here. So if it has a zero balance, we do not bring it here. So let's go through the list. The easiest way to do is just go through the list. So we have cash with a debit balance of 1587. The next is accounts receivable and inventory. Again, they have debit balances. All three are assets, so they should have debit balance. Accounts payable has a zero balance, so I don't have to bring it over here. So the next item I want to bring over is going to be common stock, which has a $6,000 balance. Sales revenue has a 2150 balance, credit of course. Then I have sales return allowance and cost of goods sold, both with a debit balance. So I bring those numbers over here. Once I'm done bringing all the numbers into the trial balance, I add up the two sides, the debit side and the credit side. These numbers have to be equal. So remember, your trial balance is just checking for equality, that your total debits and total credits for each journal entry was correct, and that's how this comes through. Now look over here in your textbook. It tells you total trial balance is 8150, and that's a number I have. So that's kind of a little reassuring that all this work was not, we didn't make any mistake. Now, the last part is we need to prepare an income statement. Again, an income statement is a financial statement. It's a formal statement. I start out with the name of the company. In the next line, I'll write that it's an income statement, but I'm writing in parentheses as partial because I don't have all the information to finish the income statement. And the income statement is always for a period in time. In this case, it's for the month ended April 30th, 2020. What do we have in the income statement? We always start with sales. Our gross sales is 2150. Our next item is our Sales return and allowance. This is the contra account. So when I subtract that, what I come up with is net sales, 2070. I then subtract my cost of goods sold. So I'll write less cost of goods sold, and that's 1370. And that gives me the gross profit of $700. Once again, I look over here in my textbook, and the gross profit is in fact $700. So I have done all of my work over here, and it has all checked out correctly. Again, remember, when you do your homework on Wiley Plus, your numbers are going to be different. It may seem a little overwhelming. So I would suggest that you do your journal entries, have your T account if you want to on a separate sheet of paper. You know which accounts to prepare because they've given you the information. Once you have that information, going through the rest of it is very easy. So it's getting from the journal entries to the T accounts that can be a little overwhelming if you're going with your on your computer, moving your screen back and forth. So this is a more efficient way to work through your problem. Again, the layout on Wiley Plus is different, but essentially the problem is the same. So I hope this helps you understand some of the things that are discussed in chapter 5. With this, I'm going to end this recording, and we will work on the next chapter, chapter 6, in a short time.